Hey, Steve Saretsky here. Welcome back to the show. Lots to touch on this week. We're going to update what's happening in the bond market and how that's pertaining to the mortgage market. We've got an update on the Bank of Canada's upcoming rate hike or non-rate hike on July 12th next week. What I'm seeing in the housing market as we enter the summer months and as these rate hikes start to feed through into the system. I'm going to give you an update and a preview on some of my thoughts there. But let's frame up this week's video with what's happening in the bond market. Bond yields started to slide higher, surge higher actually this week on news of an ADP jobs report in the U.S. basically coming in stronger than expected. And again, I've cautioned people on the channel before, but if you look at non-farm payrolls, it kind of tells a slightly different picture. But nonetheless, the jobs data is probably one of the most lagging economic indicators. But nonetheless, it is the indicator that the Fed, the U.S. Federal Reserve, is waiting for to sort of roll over because they need the political air cover to then be able to actually cut rates. And so it's pretty hard to cut rates when not only did you miss the huge inflation spike, but you've got, if you still have relatively strong job growth, it's pretty hard to actually cut rates. So they're waiting for lagging data to basically roll over. And this comes to my core thesis of the Fed and the Bank of Canada likely over tightening. Now, again, remember, as we talked about last week, that the U.S. Federal Reserve has 400 PhDs in economics on their payroll. And yet, again, they missed inflation. They kept rates at zero for a prolonged period of time. And of course, now they're playing catch up. And so this is why I say, you can have some of the smartest people in the world. That doesn't make them necessarily right. And so, I always laugh because people go, this. People say, "Oh, Steve, he's like he thinks he's an economist or he's the economics guy in housing." And it's like, listen, I don't want to be an economics guy at all. I want to be a practitioner, someone that actually doesn't just sit in a chair in an office somewhere looking at spreadsheets. I actually want to be out there, feet on the ground, talking to people, transacting in the real estate market, renovating, building. I want to be physically in the space and putting capital money to work, so I have some skin in the game and I can say, okay, I don't want to be just someone that sits there and pontificates about markets. I want to be in the markets. And so what I do here is really just provide my opinion on basically how I'm seeing things develop in the Canadian real estate space. And what I can tell you right now, everyone is waiting with bated breath about, okay, what's going to happen now? So bond yields have pushed higher. You had your Canada 5-year bond yield touch. It just barely touched 4%. And then fell back down to the 3.9 range. But nonetheless, it's a number that's going to push fixed rates up. In fact, two of the large Canadian banks this week pushed rates up again. We got another one that's going to be raising another 10 basis points next week. So what this basically means is your most popular, all the rates across the curve are moving higher, but your most popular term, which is your 3-year fixed rate, is probably going to be, at most banks, it's going to be about 6% or 5.9, or if you've got a special relationship with someone at the bank, maybe you get 5.8 next week. So that's kind of what you're looking at moving forward. So again, we've basically had a 100 basis point move in the mortgage market here in Canada over the past 4 weeks. And so if you think that's not going to impact the market, well, I've got news for you. I think it is going to impact the market. Again, when we had rates coming off, Bank of Canada on pause, sentiment started to improve. We saw that in the pricing. Prices moved higher. Detached single-family house in Vancouver moved up by $200,000 in the span of 4 months. And now we're starting to see, I think what we're seeing anecdotally is the market has peaked out again on pricing. Not seeing any price declines as I don't think anyone should expect. If you look at the inventory today, you're still outside of 2016 and 2017 bull market. You at the lowest inventory in 18 years. So you're not going to see prices drop, at least not yet. You need inventory to build, but what we are seeing is reduced activity pretty much across the board, which means, again, instead of getting 7 offers on a house, you might only get 1 or 2. And so we're starting to see some offer nights fail. Hey, price it a little bit lower, get 5 offers, push the price up 50 grand, whatever you want to go. And it's not getting pushed up to those levels. So you're seeing sellers actually start to change back to the prices they actually want. So those are what we're seeing is these failed multiple offer nights. But again, you're not really seeing anything concrete in the data yet to say, hey, the market is drastically turning. But I can tell you anecdotally, the market's cooling what you would expect heading into the summer months. But I think the addition of these rate hikes is starting to change sentiment, and we're going to get another sentiment shift here on, I think, July 12th on Wednesday, when the Bank of Canada, I think, is going to raise 25 basis points. I personally think it's going to be a mistake. I think they've already over-tightened. You guys know my philosophy on this. But nonetheless, I think that they are going to actually raise rates, perhaps for the last time here on July 12th. I will actually be doing a Twitter Spaces with the Loonie Hour, with my friends on the Loonie Hour, Keith and Rich, which reminds me we've also got tickets to the upcoming live event in Vancouver, July 27th. There's going to be a link in this description below where you can still are about 65% sold out. So tickets are moving fast, but there is a link in the thing below. So that's kind of what we're seeing. What I found interesting in all of this other news is you had the FCAC, the Financial Consumer, basically watchdog in Canada, coming out and issuing a memo to these Canadian banks, these federally regulated Canadian banks, and telling them to extend amortizations, to ease prepayment penalties, and to reduce or remove prepayment penalties for distressed homeowners. And to not only that, but to not charge, to remove interest on interest for those that are extending out their amortization or negatively amortizing their mortgages. So, and again, this is essentially a watchdog that is coming down from the top of the federal government level. You'll remember in the budget, Krista Freeland, back in January, put in the federal government's budget for the year saying that they wanted Canadian banks to work with all these people that were hitting their trigger rates. So now you've had the FCAC come out this week, aka Krista Freeland, come out and issue a memo to these Canadian banks. Now, again, so we'll have to wait and see, how that all plays out. I think it's more interesting just from a sentiment perspective to see that clearly policymakers are starting to get pretty nervous about this, as they should. I mean, again, I've talked about this. I've been surprised about the resilience in the housing market. But if we've got mortgage rates at 6%, this time next year, my bias is towards lower prices. It is what it is. I mean, we had a 10 to 15% decline in house prices last year when mortgage rates were at 5.5%. As the prices came down about 15%, and as the mortgage rates came back down into the high fours, we obviously saw the resurgence back higher in prices. So now that prices are back almost to peak levels of 2022, and now rates are moving back up, the level of affordability, it has just blown up. And so something has to give. Either the rates have to come back down or the prices are going to have to come down. The prices coming down is going to take time. It never happens in 1 month or 2 months or 3 months. It takes time. But I think, if the Bank of Canada moves again here on Wednesday, again, it just kind of compounds on the sentiment. The negative sentiment will build. And I think my bias is towards lower prices over time, assuming that rates stay at these levels. And again, if rates come back down into the fours in October, then again, the conversation can start to change again. But I think what's important to note here is, it was funny. I was doing a conference the other day to talk with 50 of the top doctors in the industry and dentists in the industry. They're asking, okay, when to buy and what to buy and where the opportunities are. And I said, they're asking about investments and growing their portfolio. And I said, listen, I personally I don't like the investment side of it today. I don't think there's really any compelling deals in the market today. Again, I think if you look at a primary residence that you're going to live in for the next 7, 8, 9, 10 years, and you're going to raise your family there, it's a totally different conversation. But if you're strictly looking to deploy capital into the real estate market today, strictly as an investment, as a buy and rent, I don't like the opportunities in that space. You're literally being paid 5% in a GIC to sit there and wait for opportunities. You're getting paid 5%. And what's happening is the prices of like a one-bedroom condo in the city of Vancouver or the city of Toronto, for example, they're not discounted. They're arguably, in Vancouver, I'd argue they're actually at record highs right now, despite mortgage rates being at 6%. Yes, rents have pushed up, but certainly not enough to cover your costs. There's a great chart here put out by Ben Rabideau showing the negative cash flow situation for investors in Toronto, and you can see how that's deteriorated, right? When you had mortgage rates of 1.5%, yeah, prices were high, but when you actually started to offset for the reduction in principal payments each month, because at 1.5% mortgage rate, 60% of your original payment is going towards principal. It makes it a relatively compelling investment, especially when you're earning 0.5% in a GIC. But the conversation has completely shifted today. So that's personally how I'm looking at it. And I think that as interest rates push higher, as the cost of capital becomes more expensive, you have different investors have different alternatives, and so you're seeing all this cash flowing into the bond market, attracting higher yields, into GICs, into money market funds, etc. And so we're actually seeing a fall off in new housing development. And so if you look at this is one of the top commercial brokers here in the city of Vancouver. Where showing all these projects that are basically going to be shelved, and I can tell you we can see it in the CMHC data again. Housing starts rolling over. It won't be a problem in the next 12 to 24 months on the supply side, but as you look 4, 5, 6 years out, this is going to be a real issue, and that's why I continue to believe very, very strongly that the politicians in power will not be able to figure it out. The system is too complicated. We'll be talking about housing affordability issues 10 years from now. So there's a lot of noise going on right now with interest rates, central banks, everyone's waiting for the housing market to collapse. All I can tell you again is right now, anecdotally, housing market is once again slowing. I think it's going to continue to slow so long as rates remain at these levels. The Bank of Canada is going to over-tighten. I think they've already over-tightened, and we'll get confirmation of that next week, July 12th. So as always, hope that helped. See you next week.